Now we turn to the Federal Reserve, which is the central bank of the United States. A central bank is the organization responsible for conducting monetary policy and ensuring that a nation's financial system operates smoothly. In the United States, the central bank is called the Federal Reserve, often simply referred to as the Fed. The Federal Reserve has what is known as a dual mandate. This means that it has two main goals: maintaining low and stable inflation, which is typically interpreted as around 2%, and promoting maximum employment. The structure of the Fed is semi-decentralized, meaning it combines the government appointees with representation from private sector banks. It is run by a board of governors consisting of 7 members who are appointed by the President of the United States and confirmed by the Senate. The Federal Reserve was intentionally designed to be politically independent, but still accountable to Congress. This independence allows it to make monetary policy decisions without direct political pressure, which is important for maintaining credibility and controlling inflation. At the same time, it must report to Congress and operate within laws passed by Congress. The Fed has a unique decentralized structure that includes 3 main components: the Board of Governors, the 12 regional Federal Reserve banks, and the Federal Open Market Committee, commonly known as the FOMC. Together, these components form the central banking system of the United States. The Board of Governors is located in Washington, D.C., and is the central governing body of the Federal Reserve. It consists of 7 members who are appointed by the President and confirmed by the Senate. Each governor serves a 14 year term, which is intentionally long to protect them from short-term political pressure and to promote policy stability. The chair of the Federal Reserve is the most visible member and serves a renewable 4 year term. The current chair is Jerome Powell. Although the chair has only one vote in policy decisions, he set the agenda for meetings and served as the public face and spokespersons of the Federal Reserve. The Federal Reserve System also includes the 12 regional Federal Reserve banks spread across the country. Each regional bank supports the commercial banks and financial institutions in its district and monitors economic conditions in its region. This regional structure ensures that the monetary policy reflects the economic conditions across the entire country, not just Washington, D.C. Among these regional banks, the Federal Reserve Bank of New York plays a particularly important role because it conducts open market operation, which are the primary tool of monetary policy. The Federal Open Market Committee, or FOMC, is the Fed's primary policymaking body. It is responsible for setting interest rate targets and guiding monetary policy. The FOMC consists of the 7 members of the body of the governors and 5 of the 12 regional bank presidents. The president of the Federal Reserve Bank of New York is always a permanent voting member, while the other 4 regional presidents rotate. The FOMC meets 8 times a year to assess the economic conditions and decide whether to raise, lower, or maintain interest rates in order to achieve the Fed's dual mandate. The Federal Reserve performs 3 major functions. First, it conducts monetary policy by influencing interest rates and the money supply to promote stable prices and maximum employment. Second, it promotes stability in the financial system by supervising banks and monitoring financial risk. This role became especially important after the financial crisis of 2008. Third, the Fed provides banking services to commercial banks and other depository institutions. It also serves as the bank for the federal government and processing payments and managing treasury accounts. Together, these functions make the Federal Reserve one of the most powerful economic institutions in the United States. Thank you for watching.